With stocks flat this year and down nearly 30% over the last decade, how can you protect your nest egg and earn back what you've lost? Here with advice on how to prepare for retirement in these uncertain times is John Carl, president and founder of the Retirement Learning Center. John, it's great to have you here with us.
Great to be here, Rebecca.
And there's just so much panic out in the markets right now, so much panic among investors, those who aren't even playing the markets. What's the number one thing people should be doing with their savings right now?
The key here is I think you really have to remain an investor in these times. As you said, the markets are depressed, and the more you can systematically save in tax-deferred retirement vehicles, it's going to pay off in the long run for you.
And what types of vehicles are you talking about?
Well, your retirement plan, number one. I mean, as an investor, first and foremost, if you're at a place, an organization that's sponsoring some type of retirement plan, maybe even offering you a match, essentially giving you free money, take advantage of that. That should be your first and foremost place to max out your savings.
So there's no real new normal. There's no let's change our point of view now that the market has been a lost decade.
Essentially, no. If anything, if you have the capacity to do so, we've been urging investors to double down their savings rates at these depressed market levels, because really the more you can stock away at lower levels, when the rebound comes, there's more dollars working for you.
Pension plans have been a major point of focus, both politically as well as economically speaking. You say people need to prepare to get less from their pensions. How do they do that, and how much less are we talking about?
Yeah, it's an excellent point, and it's really catching a lot of attention now, both down in Washington and the media, of course. Corporate pension plans, we do have historical precedent of people accruing a benefit and not getting that full benefit. Folks like Bethlehem Steel, the Delta Airline Pilots Association, Circuit City, those folks had full pension plans that when they went into bankruptcy, the corporations, they were allowed to shirk their pension benefits. It gets taken over by a government agency, and usually a materially lower amount gets paid to the pensioners.
So how do people prepare for that? What should they be thinking? What should they be doing differently?
Well, there's really not much you can do because it's out of your hands. It's really the fate of the corporation. That said, we are seeing a lot of people who, when they do reach those retirement dates or they switch jobs, we look into those pension plans to see whether they have the opportunity to take something called a lump sum distribution versus an annuity stream of income. And a lot of people are taking that lump sum distribution, which is essentially just a net present value calculation of what the lifetime income would be. They're rolling it into an IRA, and then they're in charge of those assets versus leaving it in the plan.
So take the lump sum, roll it into an IRA if you're concerned about your company's pension plan.
Certainly consider doing it. You have to weigh both facts, but we are seeing a lot of people having a lot more interest in these lump sum distributions. So yes, definitely take a look at that.
We're also seeing a lot of people withdraw money early from their 401ks, from their retirement plans, 10-year highs according to Fidelity. Is that something people should be considering, and are there circumstances that make sense for an early withdrawal?
Well, I'll tell you, Rebecca, it's interesting. I always try to say treat your retirement plan, your 401k or other, kind of like your own personal Federal Reserve, and banks call that the lender of last resorts, if you will. So it's there if you need it. But really, you want to exhaust all other possibilities before you start tapping it, because there are some material issues that are negative from tapping money out of your 401k early.
I've been talking to viewers at the early show, and oftentimes they'll come and ask me questions about, should I withdraw from my 401k under these terms? One person asked me, I have an interest in buying a home. I'm 30 years old. I want to buy a home right now. I don't have the down payment, but I see how low interest rates are, and I see how depressed housing prices are. Should I be withdrawing from my 401k for the down payment? What would you say to that?
Well, that's a tough one. That person at least is using it for an alternative investment purpose. So if they're getting a great deal on the home, they think they can have better returns in the housing market, and obviously it's where they're going to live. Maybe there is some logic that can be said there. The feature that they'd be taking advantage of would be called a non-hardship in-service distribution provision. And we do see people who are not happy with their 401k investment choices, or they're not getting good advice and counsel, or they're concerned about the fees related to their plans, taking advantage of these in-service distributions sometimes, and that might be an appropriate one.
For those who are closer to retirement, who have really seen their nest egg dwindle over these last couple of years, is there anything specifically tailored to them that will help them rebuild in these final years before retirement?
Well, it's a great point, Rebecca, and in fact there are some very attractive programs available for people who are 50 years or older. That's the magic age where the government came in and said if you're 50 or older, obviously getting a lot closer to that retirement horizon, you can actually overstuff your IRA or your 401k plan with what's called a catch-up contribution. And by all means, folks who've experienced the market decline and you're looking at lower levels in the marketplace, it is an absolute must, if you can at all afford it, to be overstuffing those plans right now, getting ready for that upcoming retirement.
One last question. You're 30 years old, you're a long ways away from that retirement age. How should you be thinking about your savings right now today?
For a 30-year-old, there are a lot of options and features that are out there. Many 30-year-olds are not making the big bucks yet. They're poising themselves for the future career. There is a tax savers credit that's available to many folks who are in the lower income brackets right now, and that would apply to a lot of 30-year-olds, where they can actually get government tax credit for making any contribution into an IRA or a retirement plan. Not a lot of people are aware of that. The other thing I would say too is for someone in that situation who's younger, the Roth IRA, or if their company has it, the Roth 401k really becomes a very attractive feature, because those assets, while they'll go in after tax, you won't get an immediate upfront tax deduction, they'll grow tax-free for life for that individual. And if they never need to take them, like traditional IRAs have to get withdrawals, Roths do not. So the Roth tax-free compounding for life, tax-free income for life, pretty good deal.
John, thanks so much for being with us today.
Thanks, Rebecca. Pleasure.
And thanks to you for watching.